What's going on, guys? This is Wade with Trade ATS. So in this video, I want to address something. It's by far what we get the most comments and questions about, either on our YouTube channel or on our website, is people want to know more about the software tool that we have, which is called Action Threshold Software. It's the only tool we have. They want to know, just a little bit more about how it works. The boxes, what do those mean? The white lines, the red and the green lines. What's it all mean? And how is it helpful, mostly? So what I'm going to do is I'm actually going to share with you guys some of our educational material for people that do decide to give our software a try and sign up. There's some tutorial videos we have that teaches them about the product that they're working with. So I'm actually going to share those with you today. It's going to go through the boxes, then it's going to go through the expansion lines, and then it'll go through the liquidity lines. It's going to tell you exactly the significance of these three components, how we look at them for information, and how we use that to put together a trading plan. So it's not too long of a video, but I guarantee even if you never use our software, we always tell you, you don't need our software. It's just a tool to make things a little bit easier if you want to trade with this methodology. But even if you don't, I guarantee you're going to get some really good insights as far as how the market works, and just a deeper understanding of the money flow and things that are going on behind the scenes. So if anything, just watch it for that, because I guarantee you'll definitely learn something. But anyway, so we'll go ahead and we're going to start with the boxes lesson. So check this out right now. So the first thing we're going to talk about is how our box is formed. So the ATS algorithm, it constantly looks for price contractions or tightening. Basically, the definition of a contraction phase in the market, tightening of price. Our algorithm is constantly scanning the chart for that to trigger, and when it does, it will form a box. The boxes will usually appear when the market's making simultaneous lower highs and higher lows. Now, there's more that goes into it than just that, but as a general rule of thumb, when price is tightening up, you're going to expect to see a box pretty soon. Boxes appear on the close of a confirming candle, meaning they're in the algorithm. This is one of those things that does wait till the close of the candle to complete the sequence. So that's a box you'll notice will only appear at the exact time you're getting a new candle. The reason that we had to do it this way, because we could make the boxes appear sooner, but that would also cause them to disappear if it didn't confirm, which would cause it to repaint. So to avoid any kind of repainting, we did have to go off a close of a candle on this specific function. And like I said, I think that speaks for itself. We don't want to have anything that repaints. We want it to be what it was. So when you do your back testing, you can see an accurate representation of what happened. Now, when it does close on that current candle, the formula can be met, and the box can already be broken out on that same confirming candle. So if you ever do get a box that appears but price has already left the box, that is because of that single anomaly. And again, that is because we don't want to have anything repaint. So that will happen. It's very rare, but it can happen. It's just the way things are. So what do boxes represent? Boxes are the starting point for the next significant market move. Phase 1 of 3 in the three market phases, the contraction phase. The box represents the starting point of that. What they are technically, they're a defined zone where the market maker can do two-way business with buyers and sellers, meaning there's buying and selling demand in these boxes. The market maker can easily match up those trades, and the market maker can collect lower risk spread commissions in this area. So when it comes to that source of a market maker's income, their main source, which is the spread commissions, this is a very low risk area for them to collect those commissions back and forth until the market breaks. So the market maker can use this time, the time that we're in that box, to assess current overall supply and demand and plan their risk control strategy. So when we exit that box, the market maker can use that phase 2, the expansion phase, to adjust their risk in their overall book of business in preparation for the next market move to higher or lower prices. Now, I want to make a point right now. When I talk about them planning their risk control strategy, this could mean that when we go into that expansion phase, depending on what the market maker's needs are and how they need to adjust their portfolio, that can be the cause of the market whipping back down or back and forth across the box, or immediately going into phase 3, which is the trend phase. This is defined by what the market maker needs to do based on what happened in that box, where the box was formed, and under the circumstances that the box was formed. So why are boxes important? They help you define expectation of upcoming market behavior, which this can serve as an advanced volatility signal. This is really important. Let's look at an example right now. So when you see the contraction box, you see that form on your screen when the software triggers that box, what is coming next? You know that the expansion, the immediate coming out of the box and leading into the trend, you know that those two phases are next. And sometimes the expansion, remember the definition of expansion is simply leaving the box. Depending on the market maker's needs, it can go directly into the trend phase, but more times than not, you're going to get more expansion activity where it plays around with that average price line. But point is, when you get that box, you know that that expansion and trend is coming next. So when it comes down to timing volatility, if you look at this trade, if you're looking for tradable markets on a daily basis, it would be better to find a market that is freshly expanded out of a box on the daily chart and start trading that more aggressively rather than a chart that has already ran in a trending direction for, say, a week or 2 weeks. So when it comes down to finding markets that are going to have volatility, which we need as traders, finding something that's in a box, that tells you that this market is about to move and money is going to be able to be made in that market easier than a market that's going to be slowing down and going into a box. You don't want to be there late. I just want to jump in on a chart real quick and show you a quick example of what I'm talking about. The timing of volatility, we're looking at a daily chart of gold right here. And you can see we had these expansions come out of the box. And right there, that would be a volatility signal, simply leaving the box and you get a new white line, which is the expansion line. And then we get movement away from those levels. There's one, here's another one. And then eventually, we do get into these tighter periods, and when you see that that's happening, then you back off of that overall market. But as a rule of thumb, that is a volatility signal. Leaving the box means that volatility is coming into the market on that time frame. And on a daily chart, if you're trading on a daily basis, trying to make money in and out of sessions, New York, London session, you would want to know when this is happening, and that's also what we have ATS Assistant for, to tell you that's a simple volatility signal, the box expansion signal, meaning that it's time to get ready to start trading this market away from average price or seeing how it behaves. Again, volatility signal right here, volatility signal right here, volatility signal here, here, here. Big moves, especially if you got a market that has as much interest in it as gold does right at this particular point. Obviously, it can slow down, but markets like Bitcoin, markets that have a lot of interest in them, a lot of people coming into those markets, these volatility signals can be extremely powerful. Okay, so the next reason boxes are important are because they provide you with the market maker's starting accumulation point for their book of business. So let's take a look at another example here. So again, we see we have a box here. We had an expansion upward, came through, fell through the average price of that contraction period, came back up, held below, and then continued on down. This is a balance point of the market maker's book of business, and these levels provide us with the point of control for the different market maker significant levels where they're going to manage their book of business. So again, this is very important information for us to use in our overall analysis when we're looking at the ATS chart map. Boxes are the basic building blocks of all market framework that dictates future price movement. Boxes, because they're that point of control, because they're the balance point of the market maker's book of business, and the market makers ultimately control the floodgates of liquidity with how they manage that book of business, these sensitive levels create that consistent market framework for our analysis and for us to form our understanding of where price is headed in the future. So how are expansion lines formed? Expansion lines appear when our algorithm is confirmed price has left a contraction zone. So it's left the first phase of the market and it's signaling the expansion phase of the market. That's why we call them expansion lines, because they're a signal to that. The lines will appear either immediately after price exceeds the high or low of the current box. So when it breaks out of the high or low of the box, you'll get an expansion line. Or it can happen on a box confirming candle that is already broken out. That is that one candle lag that happens. It's very rare, but it can happen. If price confirms a box and breaks out of it on the same candle, then you will get a box appear, and an expansion line will have already appeared as well on that candle. This is something, it's very, very rare that it happens, but it has to happen this way so that we don't get any kind of repainting. So there's definitely a benefit to keeping it that way. Expansion lines can also appear by themselves without an attached box. These will appear when the ATS algorithm has identified a relevant expansion point, even though the contraction formula was not met immediately before. This happens due to the nature of how different time frame specific candles open and close. So, and these expansion lines mean the same thing as ones associated with a previous box. This is the sophistication of the ATS algorithm. These expansion lines, they don't have the box before them, but they are a relevant expansion point. So you want to use them just as you would use a line that's coming out of a box. It means the same thing. So take it as very relevant information. So what do expansion lines represent? Expansion lines are the dividing point between market taker buying and selling pressure relevant to the time frame being viewed. When we talk about market takers, these are not market makers. Market takers do not have a responsibility to make a market for someone else. They're just getting in. They need the market makers to make them a market so they can speculate on price at will. So this is going to be the dividing point between where they want to buy and where they want to sell as a general market. The expansion lines also represent the balancing point for the market maker's book of business. Like we talked about in the boxes in the last lesson, that expansion line is going to be drawn forward and represent that balancing point, which we will also sometimes refer to as average price in some of our other trainings. The expansion lines serve as a leading indicator of volatility entering the market. This means the markets are about to move. Get ready. Again, we covered this in the All About the Boxes lesson. When you see that white expansion line pop up, that's a volatility signal. That means that on that time frame, relevant to that time frame, markets are getting ready to move away from that average price or that expansion level. So let's look at a typical example of this all playing out. So in this illustration, we have the market that's ran up. It's formed a top. So we see some increased selling pressures coming into the market. But meanwhile, it is still in an uptrend. So you still have buying pressure for people following the current trend, expecting it to break long. When this evens out, you're going to get a situation in the market where it becomes that market maker balance point, that place where they can do two-way business very easily and collect a lot of spread commission. Eventually, it's going to break from this balance point, which would be our expansion phase. Then that's where, in this scenario, market is coming down. You have now the market's actually moving down. Traders can see that happening, so the selling pressure is going to start to outweigh the buying pressure because of that confirmation. Since the market maker is facilitating all that business, their book is going to get heavy with buy positions. If they choose to, they can balance this out by driving the market up through average price. Now it reverses. Now, because we're above that pivot point, now the market maker's book starts getting heavy with sell positions, which can be by design. They could want this to happen. And then eventually they can drive it back down, and you see eventually they'll hedge their positions and they'll let the market fall naturally. They control those floodgates. As we get through the average price, then it goes into the real trending move down to lower prices in this illustration. But you can see how that expansion level, how the market behaves around that sensitive price level. That's very relevant information when we're forming our analysis, and that's why the expansion lines are very important to understand. So in conclusion, why are expansion lines important for us as ATS traders? They provide exact price levels that make up the underlying framework of real buying and selling dynamics. They give ATS traders specific prices where current market sentiment will change. Again, going back to the basics, if you're above expansion, you're going to have increased buying demand. If you're below expansion, you're going to have increased selling demand. That's that pivot point, that point of control that gives us that framework. They provide ATS traders a solid basis for decision making and strategy execution. They are not controlled by specific indicator settings and yet give the same predictable information every single time. This is so important for creating the underlying stable platform that you're learning to trade on. This is so important because it's the same every day. It doesn't make it easy, but the fact that there's no settings to change gives you the same screen to look at, the same market behavior to classify, which will get you to be able to feel price and understand where it's headed over time. The more time you spend with this chart mapping system, the more you're going to be able to feel around the framework that the markets create using the ATS chart map. So this makes them a key factor in providing evidence against random walk theory, which makes them a building block that shouldn't be overlooked when constructing a successful market approach. By understanding the expansion lines in the ATS chart mapping system, you'll quickly understand that there's no basis for random walk theory in the markets. The markets are not random, people do not all act rationally in the market, and the markets do trend, which gives us an edge. So by using the expansion levels as the overall structure, looking at how they act together, that provides you with that solid framework, and when combined with an overall trend, it gives you a pretty lethal approach to be able to understand the inner workings of the trend and the sensitive price levels that will either propel the trend or cause the trend to fall apart, depending on how price interacts with those levels. So how are liquidity lines formed? Liquidity lines are left behind every time there's a new expansion line formed. So every time we go into the expansion phase, you get that white line. It's going to be accompanied by a liquidity line as well. They come as a pair. If it's an upward expansion, a buy liquidity line will be left behind. If it's a downward expansion, a sell liquidity line will be left behind. So what do liquidity lines represent? Liquidity lines represent the sensitive price levels where traders will be pressured to close their trades. So these are the ultimate points where if traders have entered a buy or sell position in that recent structure, it breaks out and price comes back to test that liquidity line, those traders are going to be out of the money and they're going to feel pressure to close those positions, whether they be buy or sell positions. Red lines are where traders will close out their previous sell positions, so they previously sold the market, which will cause them to buy, so it'll cause a flood of buying demand to enter the market at that red liquidity line. Green lines are where traders will close out their previous buy positions, causing a flood of selling demand to enter the market. We're always looking to do the opposite of those traders, so when they're getting forced out of the position, we should be looking at, is this an opportunity to do the opposite? So if they're being forced to sell their position, should we be buying? If they're being forced to buy or close out their sell position, should we be selling? That's what those lines represent. Okay, let's take a look at a quick example of what I'm talking about here. So we have some market activity here. We have a contraction phase right here, of which it broke out long. So the traders are naturally going to want to buy as we break out of that contraction period because it's confirming that long price movement. With that, it's going to come a liquidity line. See, it says T1 breaking point. So that's going to be, if they bought right there in that breakout, that's going to be their breaking point. Now there's another contraction phase here and another breakout to the long side. So we're going to say trader 2 now buys here. So we got traders getting heavy on the long side because they're seeing the price crawl up. Now, market comes down, test those breaking points. Those traders now are out of the money. They feel uncomfortable. Trader 1 and trader 2 sells for a loss because it's below where they got in. Market makers always doing the opposite. We're trying to do the opposite of what the masses do. So this becomes buying opportunities for us. Remember, they're selling those buying positions. We want to do the same as the market makers. We want to do the same as the smart money. Since the heavier, the smarter money is coming in to buy the market, it's going to cause the market to go up. Trader 1, trader 2 jumps back into the market because now they say, okay, it's really going long now. This is it. This is finally the trend. They jump in. Market maker sells for profit back to the same people that took a loss earlier, and the cycle goes round and round and round. So those liquidity lines are going to help you to understand the market framework and this activity as it plays out. So why are liquidity lines important for us? Liquidity lines play an important role in understanding the market maker's risk profile. Okay, let's take a look at another example here. Going back to that same section of market we looked at before. Remember, we had the two contraction phases, which, remember, those were the market maker's balancing point from the previous lesson. If those are a balance point where you have your expansion and you have your box and that's defined, then those liquidity line levels become a future unbalancing point, because we know that a buying or selling demand is going to come into the market as traders are forced to get out of their positions, that their positions, their beliefs are being tested. So those become market maker unbalance points. Now, how the market makers treat those unbalance points gives us a lot of insight into what's going to happen in the market, since the market makers control the floodgates of liquidity. So the fact that the market makers, we had this strong reaction to the upside, shows us that the market makers book is naturally filling with buy positions. As it goes up, traders are going to want to chase the market, like we saw before in the before illustration. This means the market maker's book is naturally going to fill with sell positions and rebalances. In this ideal scenario, which the market makers love, they're not only able to collect the spread inside the boxes, but they're actually able to collect some profits out of the actual market move. So this is an ideal situation for a market maker. Market entries and exits become based on available liquidity for market movers and not our own models. When we're using liquidity lines for our analysis and seeing how price interacts with those levels, those are sensitive levels for big money movers. So it keeps us focused on the people that are actually going to move the market, so we can tag along and figure out what they're doing. Let's take a look at an example. Let's take a look at this section of market here. You notice we have all these green liquidity lines down here at the bottom of this turn. This is where market movers, big money, smart money, they're able to buy the market with plenty of available selling demand. Remember, the green lines represent where people who have previously bought are now getting forced out, or they're getting pressured to close those buying positions, causing selling demand. The other side of that sell is a buy for the smart money, right? So all through this turn, they're able to pick up that through that selling demand, they're able to fill a giant buying position. As the market moves up, now market movers are able to scale out of their positions with plenty of buying demand. Remember, they're always doing the opposite. That's how the smart money trades. If everyone traded the same, there'd be no edge. So understanding these liquidity lines and using them in the map can give you a sense of where the markets are, when the markets are turning, and also give you those projected price targets. Once you actually catch the trend, where is this market potentially going to push to, and where should I be scaling out of the trade myself? So you align yourself with that smart money. So in conclusion, with why liquidity lines are important, liquidity lines give ATS traders, they give you advance notice of liquidity that will create opportunities and shape future market outcomes, thus becoming a map of the future. So when you put liquidity lines together with expansion lines and boxes, you get that entire stable framework that gives you the deep inside view of the market and allows you to predict with excellent accuracy what the possibilities are of the future. You know that if it goes through a sensitive level and it acts a certain way, it's going to mean this. If it goes through another sensitive price level and it reacts this way, you know it means that. So it allows you to act in real time the same way the smart money does. All right, so that covers the three main components of action threshold software: the boxes, liquidity lines, and expansion lines. We also do have a few other tools. We have an EA that we use called ATS Assistant that helps us find possible entries into the market. And then we also do have this new component coming out called the ATS Expansion Index. It's not out for the public yet, but it will be out soon, which is going to be another awesome tool to go along with the base chart mapping software. So anyway, hopefully that answers any questions you had. And even if you don't use our software, hopefully you got some insights into the market, because we always do want to put out good quality free content that is valuable. And that's what we're all about. So anyway, till the next video, we'll see you later.